Alright, I think we should be recording. Just whack that over there. But yeah, just a quick video again today, guys, on Audioboom PLC. This is actually a UK LSE, which is a London Stock Exchange listed company. I thought I'd just make a video on it just because I've done the analysis, so might as well. And I think one of my plans this year is for every company that I do an analysis on, just to make a quick video on it and then put it on the channel, and then obviously share the document with you guys. So as always, if you want to look at the document yourself and go more in depth, because again I won't really go into everything in here, then in the description down below you can go grab the file for yourself. But I guess a bit on what Audioboom is and what they do is, so they essentially are a media tech company. And what I mean by that, by media tech, I guess, is they operate in the podcast sector or industry, and essentially bring creators and advertisers together via their platform and via, I guess, their work. A good representation of this is the actual business model they provided in their last earnings call, where, as you can see here, so essentially Audioboom sit in the middle between the audience, the creators, and the advertisers. And through their platform, creators with their podcast can essentially click one button and upload across all these different platforms, right? So like Spotify, YouTube, Apple Podcasts, all of them, all the kind of ones that you'd go to yourself, through one click of a button, and essentially gets uploaded across all those platforms. And then on the advertising side, what they also provide is they have a group of advertisers who work with Audioboom, and then they match those advertisers specifically to the best or most relevant creators. And so it is kind of this middleman service, but also just kind of makes the whole process a lot more efficient and kind of brings everything together. And they sit, like I said, they sit in the middle of all of that. Some of the podcasts, I guess, that you guys might have heard of is the ones that I guess the partners at least, stuff like Case File True Crime, the Tom Dillon Show, the Cycling Podcast, and then they also actually produce some podcasts in house. With one of them being the F1 Beyond Grid, which I've personally obviously listened to myself as well. So I just got some comments here on the business model, which I'll let you guys either pause the video or again grab the document yourself and you can read further. But in terms of where I guess the main revenue is generated from, it comes from just selling the adverts, I guess, or audio ads inside the podcast. So like doing ad insertions, and then when the host reads out a sponsorship, they take a cut of that because again they provided the sponsorship to the creator. They do make some revenue from their own production in-house podcasts, and then also obviously the platform/hosting fees, where they again allow creators essentially to go on the platform and then click one button and upload everything through that, and they take a small fee as well. In terms of the main cost drivers of the business, again I won't go too much into this one, I'll let you guys read it. Then there's one thing I would like to flag, which is the minimum guarantees, which again in the quantitative analysis I will get into, has kind of hurt their profits, but it's what they kind of needed to do at the beginning to get some of these more high profile creators on board. And then they do actually have some R&D expenses, again with like ad tech integrations, which again we can get onto a bit later, but actually this is what provides them their moat against competitors, as a lot of their competitors within the podcast space, they either produce content themselves or again kind of do the middleman service between content creators and advertisers, but none of them really have their own technology platform where they kind of provide tech for creators then to put ads in themselves and stuff like that. So it's quite a cool moat they have as well. Also just realised I forgot to do a quick overview of like the price and all that stuff, but this is kind of I think a couple weeks old now. I think it's trading a bit below this price. As of a few weeks ago they were trading at 408 GBX, which for, again, anyone who's not familiar with the London Stock Exchange, for some reason I don't know why, but they denote the share price in pennies. So it's actually about £4 a share. They have 16 million shares in issue, which again isn't a lot to be honest, which then results in a market cap of just under £70 million, which is probably about, for the US and international folks, probably about, I'm not sure, about $90 million, but definitely under $100 million market cap company. They have just under £4 million in cash, under £1 million in debt, which then results in an enterprise value of around about 66 million pounds. Cool. So then we have the P&L here. I won't go too much again into the P&L. You gotta let you guys dig through it yourself. Obviously, I made some comments here on margins, mainly margins to be honest, but stuff like employees. But I think a couple of things I mostly want to highlight obviously is I just did like a quick MPV calculation, gave them a 12% rate, which I think in the current climate is fair. You could maybe argue maybe slightly higher given that it's a niche small company, so maybe slightly higher, but at the same time they're quite established in the industry. And obviously rates are, I don't really see rates going up much higher. I don't see them going down very quickly, which again, that's all for like another topic in terms of macroeconomics. But yeah, I've given them a 12% rate. Obviously their cash and debt balance we've gone over, and then that yields an MPV accounting for cash and debt of around £88 million, which would yield around a 5.37 or basically about a £5 price target, representing a roughly about 30% upside, purely based on the P&L and quantitative. In terms of how I came up with the MPV or the discounted cash flow, so I've taken the revenue forecast or guidance that management themselves have given. So FY24 results, this is basically confirmed. It is going to be around $73.4 million. So I think I should note this is all in dollars now, which again comes up to another point. But yeah, it's all in dollars. So they made $73 million, pretty much confirmed for FY24. And then obviously the gross profit, they've kind of again released themselves. You can go into the Q4 2024 tab here. This kind of came out, I think, a few weeks ago. So yeah, they kind of confirmed they made 73.4 million in revenue. The gross margin figure somewhere here. Yeah, so you can basically, if you calculate all of these four figures from each quarter for the year, it comes to, again, the gross margin figure of around 14.3 million. And then obviously for the admin expenses, I just gave them a fixed price, a fixed percentage, of a 22%, which then yields an operating profit of an operating loss of $1.8 million. And then, I didn't really do any forecasting or analysis on, I guess, the less important aspects like finance, income, taxation, purely because, again, I'm not really too big of a fan of MPV and discounted cash flow models, just because a lot of the time you do so much work into them and you end up yielding, like even here, like a result that's pretty much close to the stock price anyway. Because as much as you hate to admit it, a lot of your biases that you input into the figures are always pegged to how the company's currently performing. And that means the reason why so many sell-side analysts, when they release their price targets, it always moves up and down with the price, and it essentially becomes like a lagging indicator. So I didn't really bother going into it too in-depth in that. You obviously, if you download the file, you can unhighlight these cells and plug it in what you think yourself, but I've kind of ignored it. The main operating profit comes from the adjusted EBITDA as a percentage, so it's around 60%. The reason for this we can get into in the fair value analysis section, but yeah, it's about 60%. I've given it based on adjusted EBITDA, which again, these two this year of 3.4 million is confirmed, and then the 4.5 million comes from the guidance that they've given themselves, and then we've just given a 60% net profit income of that adjusted EBITDA. And then obviously all those total comprehensive incomes, what I've done for the forecast on my end is I've essentially went into the adjusted EBITDA and forecasted 6% based on the revenue, which the revenue is essentially the revenue then from FY26 and beyond is what drives the growth projections. And the reason I've done that is because we don't have too much clarity on what they foresee their profit or even their adjusted EBITDA performance to be going forward, but they did give us some clarity in terms of revenue guidance in their last earnings. I'll show you here. Through this, essentially this growth model they've provided, talking about revenue, where they essentially said the industry is expecting around a 22% revenue CAGR or CAGR, however you want to say it, compounded annual growth rate. And so they forecast by 2030 roughly to have, if they keep in line with industry growth, which they've actually outperformed industry in the last 7-8 years, but if they can at least keep in line with the industry expected growth, they should have around 215 million in revenue, which is then what we kind of forecasted out here to achieve. And then we've just and then we've just given them the adjusted EBITDA pretty much based on a flat, what kind of where they're performing already. They're slightly creeping up again because through the qualitative analysis, which I'll get onto, I've kind of given them an extra couple percent margin. Cool aspect actually I do want to bring up of this trade for any UK investors is the forex. So they actually don't hedge their forex difference. So as you know, obviously the whole financial statement is reported in dollars is because the primary revenue generation is all comes from dollars as well, which then obviously usually with a UK company, if a lot of their revenue generation is in a foreign currency, usually see forex hedges. Unfortunately, or maybe fortunately, again how you want to see it, Audioboom don't actually do that. So in FY22 they incurred a 2.3 million loss based on the forex, and then in FY23 they actually recorded a £1 million $1 million gain due to forex. So again, it's actually quite an interesting play as well if you're bearish on the pound and you want some long USD exposure while also investing in, I guess, a micro cap London Stock Exchange company. It provides quite a unique trade, I feel like anyway, where you're getting this exposure to quite a niche, small but quite cool growing company in Audioboom within the podcast sector, which again is expected to grow by 22% on a compound annual growth basis to 2030, while also having this pretty nice, I guess, hedge against the pound as a UK investor especially. So so that's something I wanted to raise as well. Cool, yeah, and another thing to point out actually is the asset turnover ratio. Essentially what the asset turnover ratio is, as I can show you here, is the total assets or gross assets of the company divided by the P&L. The revenue. And so yeah, based on around $21 million of assets, they were able to generate roughly $73 million of revenue, which is really good, and I guess kind of shows how quite lean and efficient the business is. So while again the balance sheet isn't that great, the fact that the kind of revenue that and hopefully eventually EBITDA and earnings they're able to produce based on the assets they have on hand is very good actually, because it works both ways, right? So they don't have a massive asset position, but they also don't have a massive liability position. So based on that total balance sheet, the kind of revenue and profits, which at the end of the day is the most important thing for a business, they're able to produce is really good. And yeah, having a 343% roughly asset turnover ratio is just an indication of how efficient and lean the business is. All right, cool. Before I go on the main last tab here, which is the fair value analysis and talking about roughly where I'd price the stock and if I'd buy it or not, I thought we obviously look at the most important qualitative aspect of any business, which is its key performance indicators. One of the nice things, I guess, about Audioboom actually is that they tell you what their main KPIs are, whereas I think with most, at least US companies, you kind of have to do a lot of digging, listen to a lot of earnings calls, look at a lot of 10Qs and kind of guess and ascertain what their KPIs are. Whereas with Audioboom, they kind of explicitly tell you their three primary KPIs anyway, which are global downloads, RPM, and brand count. So for global downloads, this is actually the only KPI that's trending downwards. However, the actual main reason for this is the iOS 17 update. So I actually have a tab literally dedicated for this, where I kind of explain what the iOS 17 update is in terms of the issue, and then what Audioboom are doing to rectify it. But a quick TLDR, I guess, is that in the latest iOS 17 update, what Apple did was when you essentially subscribe to a podcast on Apple Podcasts on the app, what used to happen was it used to download every single podcast in that series, whereas now it only downloads like the newest episode or two. Yeah, and I guess the consequence of that essentially was there was a lot of ghosting views within the podcast space, where you download a podcast and then Apple would assume every downloaded podcast was a view as well, whereas in reality, obviously, the user hadn't actually listened to every single episode, which then inflated the global download numbers. So if we go back to here, the global download numbers were quite largely inflated because of that. Because again, it would download so if a podcast had 300-400 episodes in that series, it would try to at least, or tell Apple's statistics that it essentially had 300-400 downloads, whereas that wasn't actually the real listening figures. So obviously to combat that, Apple then introduced their latest update where I only downloaded one podcast. So that's why the global figures are down. But then again, to combat it, Audioboom are looking to expand to YouTube and more video podcasts to kind of mitigate this downtrend in global audio downloads. But another thing to point out is this global downtrend is the case for all its competitors and everyone in the industry as well. For me, the biggest KPI, however, is the RPM. So this is the amount of dollars generated per 1,000 downloads. And so I've done a quick dive in myself in terms of the RPM of other competitors, and actually Audioboom have, I think, from what I've seen, the best RPM. So the best dollar generated per 1,000 downloads in at least the podcast and audio space. I'm pretty sure like some video creators, some video platforms, like YouTube, also have very strong RPMs, but in terms of at least from the podcast side of things, Audioboom have the best I've seen, which again is a really good indicator of the quality of the business. And then the last KPI is the brand count, which is just kind of trending upwards as they get more and more podcasters and creators on board. And then I made a quick comment here about the fact that Audioboom's competitors don't really have their own ad tech platform, unlike Boom, which gives it a really strong competitive advantage and moat in the space, which is why a lot of brands are now favouring Audioboom, because they just provide more services for content creators. There's also this showcase platform they have. I don't want to go too much into it because, again, I realise the video is getting very long. But they also have this showcase platform, which is basically the ad tech platform, and the ad tech platform is by far has the best gross margins, and it's one that's growing the most. So as you can see here, it has the lowest revenue contribution. Based on just 11% of revenue contribution, it provides 32% of total gross margins. So as this grows, also the profitability of the company will increase, which is another reason why I'm again being quite prudent, but forecasting adjusted EBITDA margins to slowly increase over time as their ad tech platform and showcase becomes more used and popular and a bigger part of the business. Cool. So obviously that leads us then onto the fair value analysis tab. TLDR, the price target I've assigned is around £6 a share, or 600 GBX. This is based on the forward revenue and EBITDA numbers. So again, we already know what they are going to be for FY25 in terms of forecasted by management, where they're giving us guidance of 80 million revenue and 4.5 million EBITDA. You can kind of read this yourself in terms of then how from, for instance, the adjusted EBITDA, I infer the net income figures. As I previously mentioned, I've given 60%, which is the median point between the typical range of 50 to 70% adjusted EBITDA in terms of what then kind of feeds into the net income figure. So I've kind of given the median of 60%. So then 60% of the 4.5 million adjusted EBITDA forecasted for FY25 gives you a roughly net income of between 2.5-3 million, which is based on the 50 and 70%. But anyway, But I think that's the forecast in terms of the numbers. And then in terms of the valuation and valuing the company, I personally like looking at comparable companies. The main three I've seen are obviously Spotify isn't that comparable, but it's what a large part of the audio business is based on, and they're essentially like the premium audio stock, I believe, and they trade at PS, a price of sales around 6. There's iHeartMedia, which I think is the most comparable in terms of business models, but they don't have an ad tech platform, and they quite heavily leverage and they're indebted, and their growth is nowhere near as significant as Audioboom's, because again they're more of a mature company, but they trade with an PS or price of sales of under 1. And then some other random competitors like Libsyn and Acast have a price of sales forward ratio of around 0.5 to 1.5. So based on all of these, I kind of gave Audioboom, being prudent again, I'd give them a sales multiple between 1 and 2. If you give them a sales multiple of 1, then obviously based on FY25 projected earnings of $80 million, you'd have then $80 million EV, which translates into about just under £5 again price target. Whereas on the upper bound, if you were to give them a 2 price to sales ratio, which I don't think is too ambitious, then the stock price goes up to around just under £10. which then between those two, if you give it a mid-range, you get a price target based on sales of around £7.32, which is represents quite a nice potential upside based on this current trading price of nearly double. So again, if you were to value the company based on its earnings, again assuming the 3 million net earnings that I talked about earlier, then you want to kind of obviously utilize P/E ratio. Generally, with these kind of companies, it's quite hard to assign a P/E ratio. Yeah, they're not listed on the Nasdaq, so for a lot of London Stock Exchange companies, they do tend to have suppressed price to sales and price to earnings ratios. But if you were to give it quite a low P/E of 15, it represents a very low price target as well, actually, of £2.75, representing some significant, not significant, but some downside. Whereas if you give it quite a strong P/E ratio of 30, then you have around a £5.50 price target. So if I guess having some conviction and analysis from myself from all the qualitative aspects of the business we've analysed, like the good management. Actually, I haven't even talked about that, but you can go in the tab and you can see the good management there. But the good management, sector tailwinds, again, like I said, 22% compounded annual growth projected, and then a potential eventual US listing. So actually, I haven't mentioned this, but the company in their recent earnings call essentially announced that once they hit 100 million in revenue, so again, on our forecast, most likely either next year, FY26, or at least by 2027, they hit 100 million revenue, they will actually be listing on the Nasdaq. So you obviously have a US listing on the Nasdaq. That will bring a lot of liquidity to the stock, a lot more eyes onto the stock, and I feel like that would have a very, very strong tailwind on the stock price. So if you can buy the stock now and get in before it lists on the US and on the Nasdaq, that in itself could provide quite a decent tailwind to the stock price and kind of give it a nice or a more higher valuation than, say, a 15 PE ratio, right? So accounting for all of that, I gave it a 25 PE ratio, so more on the higher end, just because, again, of all the things we've talked about, which then kind of gives a price target of around £4.50, which essentially then kind of shows that the company, you would argue, is fair valued, whereas trading just around £4 at the moment. However, then you also need to factor in, at the end of the day, they're not that profitable. So valuing a company based on profits that's not actually focusing on profits, I think, is never really that good. With the companies like Audioboom, because they're more focusing on their top line and trying to grow the business as much as they can first, it's more, I guess, reasonable to price a company like this based on their sales. And so based on their sales, you can give a price target of around £7. I've kind of been prudent and given 6, just again to account for, I guess, lower margins than maybe some other companies. But yeah, so I'll let you guys read it and kind of see and kind of read in depth my points and why I've kind of given it a £6 price target. But yeah, I kind of realised I've gone on a bit long now, so leave it there. If, as always, you have any questions, just leave them in the comments down below. But yeah, I'll leave it there.